Today we're going to talk about deferred tax. I know this is pretty kind of confusing, difficult, or tricky, but I hope I can give you like a short explanation on how to determine the deferred tax. What are the main items that play in this calculation? And let's start by saying or giving you an introduction to deferred tax. So this refers to the tax effect of temporary differences between the accounting profit and taxable rules or taxable income. Okay. Let's start by understanding that there are differences between the rules of accounting standards such as NIF or IFRS, US GAAP, and the tax legislation of your country. In this case, I'm going to talk or refer to Mexico. So let's say that income tax rules are different than the NIF rules, and we're going to see a couple of examples to make this clear. Okay, that's the first thing I want you to understand. Now let's go with the assets and liabilities of deferred tax. Let's see. These asset and liability deferred taxes result from differences in carrying amounts of assets and liabilities for financial reporting purposes and their tax base. So let me give you one example as an introduction, okay? Let's start by saying that you make an accrual, okay? You make a provision, like we call it here in Mexico, for, let's say, a payroll accrual or a severance accrual, okay? Under NIF D3, okay? So we're recognizing an expense for future payments that we're gonna have for severance. So if you remember in our previous video, debit and credit, we're gonna debit the expenses and credit the liability. That liability will be deductible in the future, okay? So let's say that the expense that we currently have in our P&L will be decreasing our profit, but is not gonna give us a deduction, okay? That deduction will come in the future when the payments are done, okay? So that's one example. What's the balance sheet? What's the impact in the balance sheet, okay? So those differences impact the balance sheet and may lead to recognition of deferred tax assets and liabilities, okay? So when you determine, you calculate your deferred tax, you will either get an asset or a liability. It has to be one. You cannot have like a combination. You need to show the net amount. So it's either an asset or a liability. So the accounting standards provide guidance on the recognition and measurements of these deferred taxes. So let's go a little bit further to see more examples and how it is determined. So we're now going to see examples of deductible and taxable temporary differences. It's very important for you to get familiar with these two items and that you can understand what they mean. Okay, as we mentioned, those are differences between accounting books and taxable rules. Okay. So these include expenses recognized in tax returns before they are recognized in financial statements, okay? I'm talking about the deductible differences, okay? That means that they will be deductible in the future, as the example we previously shared or I mentioned before, okay? Another example of deductible differences could be, for example, depreciation. You may be using different rates for accounting purposes and different rates for tax purposes because probably your legislation is only allowing you to decrease or deduct under, 10%, 20%, and your accounting records, you have a higher rate, okay? Let's go with the taxable differences. These arise when income is recognized in financial statements before it is included in tax returns, okay? So we may have revenue that we probably recognize in our books because probably, we already sold the goods or we have a commitment to ship something, so we recognize the revenue, okay? But probably under tax ruling, that revenue must be recognized when it is collected on a cash basis. That doesn't happen too much here in Mexico, but it could happen in another legislation or jurisdiction, okay? Good. So let's explore the permanent items in deferred tax, okay? Permanent items do not reverse. That's important for you to remember. They do not reverse, okay? Impacting the effective tax rate, but not resulting in deferred tax assets or liability. So what's the logic of that? Those permanent items, as we mentioned, they do not reverse. So you're not gonna have like an expense on your P&L, and you will probably deduct in the future. So here in Mexico, it's very common to have or fall under non-deductible expenses, okay? That will be a good example of a permanent item, and also for other jurisdictions. Okay, so if you have non-deductible expenses, they will be non-deductible this year, and they will never be deductible in the future. It's not like you can deduct them in year 2, 3, 4. No, they're not going to be deductible, so they are a permanent item. Another example is inflationary adjustment calculation here in Mexico when we compare our debits and credits, or let's say, no, sorry, our assets and debts, or assets and liabilities, and we get a difference. That difference is then multiplied by the inflationary percentage that we have here in Mexico, and that will either give you a deduction or a taxable income. So that's also another permanent item that is going to be there for in your tax return, but it's not going to be in your books or in your accounting records. Okay, good. Let's talk about now about timing difference. Okay, timing differences arise when the recognition of items in the financial statements differs from the recognitions in the tax computations or calculations. So this is something very similar as what we mentioned before. Okay, we have items that may be recognized in our books, but do not have an effect on the tax return, or in the other way. Okay. Understanding timing differences is important for accurate tax planning and financial forecasting. So if you work in the finance department, it's very important that you get close to your tax person, and you can ask him, hey, so how do you determine the deferred tax? Is it an asset, a liability? Am I going to be paying more taxes in the future? Am I going to get some benefits? So you really need to get this feedback. It's really important and significant. Okay. Calculation and recognition of deferred tax assets and liabilities. Well, the calculation mentions that deferred tax assets and liabilities are calculated based on the expected consequences that they will have in the future, okay, on future events. So as we mentioned, we determine either if the expenses that we now are recognizing will have an effect in the future of a deduction, okay? They are recognized when it's probable or it's possible that future taxable profit will be available against which the assets can be used or the liabilities settle. So let me give you one example of this. Let's imagine that we have a tax loss, okay? And we can recognize a tax loss on deferred tax asset under certain requirements. Like, let's say that the company has to show or has to demonstrate convincing evidence that they will have future profits, okay? So you can get that benefit in the future of a loss. If you're not sure, you should not recognize that loss, or probably just a part of it. Okay, reporting and disclosure requirements. Financial statements. Let's talk about financial statements. Companies are required to disclose the information about the amounts of deferred tax, either if it's an asset or liability, in the balance sheet. So you should always see a number right there. I mean, it's very strange that you don't see a deferred tax, either an asset or liability. It's normally a number right there. So you should also include notes in the financial statement so you can let the people or the users that are going to be reading the financials, let them know how did you determine that number, which are like the main items that you're considering, and also if you have a loss, how you're pretending to get the benefit in the future to reduce your tax base. Okay. As a conclusion, we can say that deferred tax accounting is complex. Yes, it is. It's not that easy as we're talking at this moment. And it requires a deep understanding of tax regulations and accounting standards, okay? There are, in accounting, we normally place everything there. For example, an asset. Let's say that we have our policy or procedure, and we say, hey, this asset, this machinery and equipment, we're going to depreciate it on a 30% or a 10% or whatever percentage, okay? But you got to be aware of what your tax legislation mentions, okay? Because you're probably just going to get a 10% on your tax legislation, on your income tax law, and you're probably depreciating it on 30%. So you already have a difference right there. And also with your accruals, if you're recognizing an expense that you know is not going to be deductible, well, you got to be aware of it, and you got to take care of those situations, okay? It is important for decision making, tax planning, and financial forecasting. So if you're a finance guy, you better get near or get close to your tax person, because this may bring you either benefits or obligations in the near future. So, this deferred tax and tax legislation and everything is all evolving. It's always changing and modifying. So it's really important for you to stay updated with regulations. Especially here in Mexico, it's always like changing all the time, the law. So it's really important for you to get familiar with this. So remember, deferred tax assets, deferred tax liabilities, deductible temporary differences, taxable temporary differences. Those are like the main items I want you to remember, and also permanent items. See you.